recorded. So if you have to log off for one reason or another, fear not. We will have the webinar recording posted to our website. You can just go to our website, larkanalytics.com, click on present webinars and press releases, and you'll be able to not only view this webinar, but all past webinars as well, right there really easily. Or if you loved it so much that you want to share it with the rest of your teams, your friends, your families, you can send them the link. Hopefully that's the case, but we're also realistic. Second thing that I want to highlight is that we're going to get asked this question a number of times. I'm going to say it up front, but it's not going to matter. For those of you that are on the webinar, you will receive the presentation. We will send over the slide deck by the end of the day today. So fear not, that will come your way. Third thing that I want to highlight is that we're going to hold a Q&A at the end of the session. So presentation is going to last close to an hour, and then we'll do Q&A. I assume by now everybody's relatively familiar with the taskbar. Just go to Q&A and lob in your questions there, and we will go through that at the end. If you're raising your hand, I'm not calling on you. We're lobbing your questions through Q&A, and we will answer your questions there after we get through everything. And then the last thing that I will say is that if we do not get to your question, you can always email us at information@larkanalytics.com. With that, I'm going to go ahead and get started now. We've got about 300 people on, so that's a great starting point. This is where we're going to go today. We're going to start with kind of a quick little backdrop of where we've been over the past couple of years for the hotel industry. We're going to spend a lot of time walking through the current economic landscape and the outlook going forward and the implications on the hotel industry. We'll then jump into our forecast for the hotel industry on the top line, followed by the bottom line, and then we're going to jump into some markets. Now, before I jump into this, there's one thing that I really want to say because I think it's really, really important. In any environment, it is impossible to separate the political policy landscape from the economic environment. Those two things are very highly tied together. That is extremely more so the case in the Trump administration, because let's be frank, Trump's policies are really skewed to the economy, for better or worse. That is kind of his focal point. So, while we talk about policy and the implications it has on the economy, we are not necessarily condoning policy or, saying we don't like the policy. We're just trying to actually understand and provide insight into whether the policy is good or bad for the economy in the near term. Just because a policy is good or bad in the near term does not make it good or bad policy. It's just a good or bad in the near term for the economy does not make it good or bad policy. I think it's important to understand that we are not taking opinions on the policy, but we are trying to highlight the implications of those policy on the near-term economic outlook, which is why people are here, to help them understand how it impacts their businesses. And again, that doesn't mean that policy is good or bad over the long term or for other reasons. There's lots of reasons why immigration policy may be good for the country over the long term. That doesn't mean it's good for the economy in the near term, plain and simple, right? So with that, I'm going to jump in. As you think about, past couple of years of the hotel industry, here you've got 2024 actuals and our 2025 forecast, which is pretty close to actuals because we're already in December, right? You can see basically last year we saw relatively muted but positive growth across supply, demand, occupancy, ADR, and RevPAR. This year, supply increased almost doubled, going from 0.5 to 0.9%. Demand turned negative. We actually saw a decline of 0.5%, translating into occupancy down almost 1.5% this year. ADR growth got cut in half from 1.8 to 0.9%, and as a result, RevPAR turned negative. Now, while that's the outlook for the U.S., and that's where we are across the U.S. landscape, every market is different, and we will continue to see different markets perform differently. And if you look at the disparity, this kind of shows you in both 2024 and 2025 how varying that disparity can be. In 2024, we saw markets like Houston that were up 15%, markets like Maui that were down 10%. In 2025, we've got markets like San Francisco, Palm Beach, and St. Louis that are close to 10%, and then Houston, Memphis, Las Vegas down close to 10%. So again, as we talk about the U.S. overall, it's a great benchmark to understand things, but it is not the end-all be-all for your hotel and your market. There are reasons why given markets will outperform or underperform, and reasons why given hotels will outperform or underperform those markets. Understanding those nuances is really, really important. But we're going to talk about the country as a whole and frame things from a demand segment perspective, from a macro perspective that shapes different factors that drive overall performance. Understanding that, if we are positive on tourism, that's going to have a much bigger impact on a market like Key West than a market like Milwaukee, right? If we're, understanding those nuances is really, really important. So as we walk through those types of things, moving beyond the top line, if you look at where we were last year, muted RevPAR growth translated into a decline in hotel EBITDA of about 2%. This year, we expect EBITDA will be down more, closer to 3%. We've seen some cost-cutting initiatives, which are encouraging, which are helpful. We need to see a lot more of it. But we still estimate that EBITDA will be down about 3% this year. Last year, we estimate hotel values were actually positive despite the declining EBITDA. There were really a couple of reasons for that. Number one is as we move through 2024, the outlook for economic growth started to improve. The outlook for interest rate cuts started to strengthen. The consumers started to improve in the back half of the year, and that led to some confidence heading into the year end, which drove values up a little bit. As we've moved through 2025, that's done a bit of a reversal, where fundamentals have worsened as opposed to gotten better. Cash flows have declined more. And the outlook for next year, while maybe better than this year, it's skewed to an extent, and there are challenges that we're addressing. While the outlook for interest rates isn't nearly as opportunistic as it was a year ago, some of those other dynamics that are continuing to unfold, which lead to values moderating ever so slightly this year. Now let's talk about that economic outlook that I kind of disclaimed at the front of this presentation. Before I jump into the true outlook, I just want to highlight something that I think is really interesting. The reality is the Trump administration, has put a stamp of its unique brand of chaos on economic policy. And that's not necessarily a bad thing, but it does have implications, right? At the end of the day, think about it. Trump is a very aggressive negotiator. That's served him very well over the years in his business and professional life. But he also does it in a very public way as president. And when you come out very aggressive, very publicly, it translates into the media being a megaphone pointing to the extreme sides of things. And that creates a level of discord and a level of uncertainty across everything that's being discussed that makes companies and individuals a little bit more cautious. Well, is that really going to happen? Is it really going to go there? Can he do that? All those types of things that just cause a bit of a pause. You can talk about government cutbacks. Obviously, we knew government cutbacks were coming. During the government shutdown, he threatened to lay off a bunch of employees because of the government shutdown, right? More government cutbacks. Obviously, government cutbacks are having an impact on any bit market that has a lot of government demand. Then there's funding cutbacks. It's not just funding for the government, it's also a lot of funding for research and development, whether that be universities, other research institutions, you name it. We're seeing a big pullback in that dynamic that's impacting markets that are relying on some companies or institutions that generate a lot of that, that utilize a lot of that funding for their business. And then there's the tariffs. I'm not going to belabor the point of the tariffs. What I really want to highlight about the tariffs is we still don't know what's going to happen, right? At the end of the day, the Supreme Court held a hearing last month, and it looked during the course of that hearing that the conservative Supreme Court justices appointed by President Trump did not seem to be in favor of the tariffs and the approach that the Trump administration took to pushing them through. The poly market, not the end-all be-all, but a great indicator, saw the probability of the Trump administration winning that Supreme Court case dropping from about 45% to about 25% during that hearing alone, just based on the questions that were coming through from the conservative justices that people thought might side with Trump. Seems less likely. Hopefully, we'll get a ruling sometime soon. That ruling, if it goes against the Trump administration, does not necessarily end things on the tariffs. It just means that the approach that the Trump administration took to getting the tariffs through now has to be undone, and they have to take on a different approach. And that may be going through Congress, maybe going through different laws, you name it. We'll see what happens. It's also possible Trump will say, "Hey, I tried. It's not my fault. It's all in the judicial system. If I had complete control, I could do whatever I wanted, and we'd all be better off." You could see it go either way. We don't really know, but it creates a level of uncertainty that continues to persist. Federal Reserve independence, obviously Trump has not replaced Fed Chairman Powell. He has threatened to on multiple occasions, but has not done it. Economic data integrity is another really interesting one, which has created a level of uncertainty where following a couple bad jobs prints, mind you, that also had massive restatements of jobs, Trump decided to terminate the head of the Bureau of Labor Statistics, the BLS, and replace him with an ally. Again, maybe there's reason why that individual should have been replaced. Like I said, there's been massive restatements, but at the same time, doing it after a bad jobs print questions integrity. And then last but not least, federal government shutdown. This isn't tied specifically to Trump, although Trump has historically said that the standing president is responsible for all federal government shutdowns. So he's the ultimately one accountable. So in a way it is, but it's really tied to the dysfunction that we see in the Senate and the House between the two parties, the Republicans and the Democrats, that are very far apart on every major issue. And what happened in October, in November, for those of you that aren't fully familiar, 8 Democrats crossed party lines to say, "Hey, we'll vote with the Republicans to end the government shutdown on one condition." That condition was that the Republican Party had to bring to the floor in December a vote on the Affordable Care Act subsidies that were set to expire at the end of this month. Well, guess what? That vote happened today. The Republican Party could not coalesce around an alternative plan to Affordable Care Act subsidies, but also would not vote for the extension of the Affordable Care Act subsidies. And as a result, nothing has transpired. The Affordable Care Act subsidies are set to expire at the end of the year. We'll see millions of people see their healthcare costs increase dramatically next year. That's not very encouraging. And importantly, the negotiation and the resolution that was reached last month for the ending of the government shutdown only extended funding of the federal government through January, while the rest of the Democratic Party is adamant about the Affordable Care Act subsidies. Those 8 senators crossed party lines. It's very likely that with the Republicans not being able to coalesce around an alternative solution, that you're going to see them revert back to the Democratic side. And at the end of January, if we haven't figured out a healthcare solve, we could be looking at another government shutdown. And that second government shutdown will likely be worse than the first one. Why? Second time in a few months that FAA controllers and TSA employees are having to work without getting paid. You're going to call out more frequently. The government will probably take a more proactive approach to cutting flights and things like that. This will have a more negative impact on the hotel industry, even if it's shorter. So just something to really keep in mind, that there are plenty of risks heading into 2026. And as we talk about that, one of the things that all of this uncertainty creates is what I like to refer to as a level of paralysis in the corporate environment. And when we think about that paralysis, I use an analogy that Darryl Cronk from Tourism Economics once shared that I've now stolen because I think it's a great analogy. Compare it to the football coach of an NFL team or a college football team. Their offense takes the field on 1st and 10. They know what play they want to call because it's 1st and 10. They have 4 plays to get 10 yards and get another first down, keep the ball, and keep moving the ball down the field. Well, what happens if the rules change and it's not 10 plays to get 10 yards for a new first down? It has to be 25. The play you're going to call is going to change, right? What happens if it's not 2 plays to get those 25 yards, or not 4 plays to get 25 yards, but it's 2? Again, the play you're going to call is going to change. What happens if you have to score a touchdown on this play? Again, the play you're going to call is going to change. It's likely going to be a Hail Mary, right? So if you don't know the rules you're playing behind, you can't make a play call. And that's the environment that a lot of the corporate world is operating within in this environment with all this uncertainty. Now, granted, I don't want to blame President Trump for all of it, because frankly, the media exacerbates everything to a very large degree. But, regardless, that's the environment we're in. And it shows most easily in job growth. So basically, companies have put the brakes on hiring. There's been a huge wait and see. Let's see how things unfold. In fact, over the past 6 months, if you exclude the healthcare sector, we've seen a decline in employment levels across the US going back to March. Over the past 3 months, we're down 5,000 jobs, excluding the healthcare sector. Guess what? Medicaid, Medicare, Affordable Care Act subsidies ending. That's all going to translate into a reduction in healthcare employment in 2026. So the one sector where we're seeing any growth is going to kind of likely take a step back in 2026. Not really encouraging. What I also think is really, really important for those of you that aren't aware, there are 11 major sectors that you see on this slide here. 6 of them have experienced negative growth over the past 6 months. These numbers are over the past 3, but they've experienced negative growth over the past 6 months. Others are generally muted. In any year and any time we've seen for 6 months, 6 or more of those sectors experiencing negative growth, meaning broad-based declines in jobs, the US has been in a recession or heading into a recession with 0 false positives. That is a frightening dynamic. Really, really frightening. So we're heading into a recession, or we won't, right? Not so fast, right? The stock market, as you guys probably heard, hit a new all-time high today. The Wall Street Journal surveys economists every quarter. The October survey economists, only 33% of economists expect the US to enter a recession over the next 12 months. So how do we marry this, right? Doesn't really work. Well, the answer is really twofold and relatively simple. Number one is the stock market's being fueled by AI. Number two, and AI also has been the reason why companies have attributed layoffs. We can cut jobs tied to AI. I'm not really a believer that's actually happening. I tend to think that company AI is a great buzzword, and the public markets pick up on it and look fondly on AI. Obviously, it's doing so with the stock market where it is tied to the AI stocks. But I think at the end of the day, companies are just hiding behind that as opposed to other reasons why there may be layoffs. At the end of the day, they don't get plenty of flack for saying we're cutting for AI specifically. But I don't think AI is at the point where you're able to cut jobs because you have AI. I think that's going to get you there. It's just not there yet. The second thing that I think is probably more important is that all of this dynamic, this lack of job growth, this corporate paralysis that I refer to, is largely self-inflicted and policy related. It's not a structural impairment to the broader economy. It's about this uncertainty surrounding where the policy is going to be. And once there's clarity surrounding that, this could reverse on a dime because the structural dynamics of the economy are actually sound outside of a couple of things about a little bit. So if Trump came out tomorrow and said, you know what, I'm going to drop the tariffs, we're done, clarity surrounding his policies emerged, this would reverse. And that's really positive. So if you think about it from that perspective, there's plenty of upside from some of the things that could be done versus where we are today. Now, that being said, I want to talk a little about the implications of all of this on business investment and corporate profits. So good news is, for those of you that have followed our webinars in the past, this chart looks a lot better than it did a quarter or 2 quarters ago. Moody's outlook for business investment and corporate profits has materially improved for 2026 and 2027, frankly. However, one of the things we are still expected to see muted business investment growth throughout the remainder of this year, and then it turns negative corporate profits this year before we see some growth next year. What I really want to highlight is if you back out estimates for AI investment out of business investment is basically flat. We're looking at less than 0.5% growth each of 26 and 27. And the big question, which we don't know the answer to yet, but the big question we have is, does investment in AI have the same impact in corporate travel demand as general business investment does? General business investment usually translates into more corporate travel. Companies go out on the road to generate more revenue. Investment in AI is not about hiring more people. It's about hiring less people. And it's also about more profitability and cost cutting more than revenue generation. So there's a component here that may or may not translate into the same relationship between business investment going forward with corporate travel as we've seen historically. Same thing can be said for corporate profits, right? If AI is cutting expenses rather than growing revenues and hiring more people, it's likely to translate into less business travel, not more. We don't know if that's going to play out yet. There's no empirical evidence suggesting one way or another. We're very early here. But our gut tells us that the AI component of this business investment and the impact on corporate profits is not going to have the same relationship with corporate travel demand as we've seen historically. As a result, while business investment and RevPAR have a very strong relationship historically, 85% correlation, 72% R squared, we would argue that that relationship may start to diverge a little bit over the next couple of years until it kind of reaches a new normal and then resumes again. Same thing could be said for corporate profits, where we're seeing some strength in corporate profits over the next year or so. That may break down a little bit. Again, historically strong, not quite as strong as business investment, but strong relationship. Moving beyond those dynamics, I want to talk a little about return to office. We get the question all the time about office utilization and the acceleration of return to office. What I want to highlight here is that here's a few headlines that we pulled over the past month or two. You can pull these headlines from any month over the past 3, 4, 5 years, and they'd all tell you the same thing. However, it's not showing up in the data. This is data from Castle Systems. Past 2 months have been unchanged, hovering right around 54, 55%. The reality is the past 2 years have been just above 50%. We're not seeing any meaningful movement from Castle Systems. Now, Castle Systems isn't the end all be all, but it is a good indication. Another data point that we think is interesting is the Flex Index. The Flex Index, they survey 100,000 office locations across the country. They basically saw an uptick in office utilization, people in the office in the back half of last year. We went from 2.49 days in the middle of last year through up to 2.82 days per week in the office by the second quarter of this year. And now we're standing at 2.87. So we've kind of stabilized a little bit. As you think about those dynamics, why does that matter? Why do we care about office utilization in days a week in the office? It's real simple. If people are in the office, people want to travel to see them in the office. Not too many people take a sales call from their kitchen in person, right? It just does not happen. As people work remotely, we are less likely to see the corporate travel that coincides with that, and the sales dynamic, the revenue generation, client interaction, client relationship building, all those dynamics from a corporate transient perspective. As a result, what's happened is in 2023, the airline industry, just about every major airline across the US said that their corporate demand was back to pre-pandemic levels. Here we are wrapping up 2025, and there's not a single hotel company that has said that. And I can't think of any one of our clients that have said that. Probably everybody on this call, how many of your hotels are actually back to pre-pandemic corporate transient demand? My guess is virtually none of them. And that's one of the challenges that we're having. So how do you marry those two things? Well, the answer is real simple. It's a length of stay issue. So if I was going to fly out to San Francisco to visit clients and make some pitches to meet with prospects, historically that may have been 10 meetings and I might be there for 3 nights. However, today, if those people aren't in the office as many days, it's not 10 meetings, it's 6, and I'm only there for 1 or 2 nights. That's a reduction in length of stay, and it just has that impact. The length of stay is reduced. So what used to be a 3-night stay is now a 2. What used to be a 2 is now a 1. What was a 1 is now an out and back in the same day, and it's showing up in the corporate transient data. And unfortunately for the hotel industry, if you look at the sectors that have the most flexibility in terms of their office utilization or return to office dynamics, it's the ones that also generate the most corporate transient travel: technology, insurance, professional services, financial services, et cetera. That's concerning from our corporate transient perspective. Now, shifting from the corporate side to the leisure side, we've got a few things to highlight here. First, let's talk about consumer sentiment. And this comes from the University of Michigan, US Consumer Sentiment Index. If you remember, April saw Liberation Day. The very first consumer sentiment reading after that was in May. Came in at 53.6%. It was the lowest level outside of the pandemic in 45 years. That's what Liberation did from consumer sentiment. Liberation Day did to consumer sentiment. Now, it's not all about the tariffs. It's also about the media and the exacerbation of everything. But it stoked a lot of fear across the country. Things did bounce back in the months that followed, but then during the government shutdown, we trickled back down and we're back to where we were. So consumer sentiment really, really soft, right? As bad as we've gotten. in the past 45 years outside of a global pandemic. Great, that's not a really encouraging sign. However, retail sales growth over the past 4 months has experienced positive growth. Now it hasn't been quite as strong as we saw towards the back end of 2024, where we started to see some momentum building. Things pulled back in the first half of the year, and things have actually improved over the last few months. Interestingly, March was a great month, but that was because consumers pulled forward purchases in advance of Liberation Day and the tariffs. If you back that out, we're basically looking at flat retail sales growth this year. So definitely a pullback from what we saw in the back half of last year. But nonetheless, we are seeing positive growth over the past 4 months. That's encouraging. Second thing that's kind of interesting. The Deloitte Consumer Spending Intentions Index is fascinating right now. If you look at this, consumer spending for the last few months has actually been trending up, and we now have a positive number for the first time since middle of 2022. And the Leisure Travel Spending Intentions Index has spiked, and we're now at the highest level we've seen since 2022. So again, positive data points. So how do you marry positive spending intentions, improving retail sales, and some of the lowest consumer sentiment we've ever had? The answer is right here. And this is a chart that scares me. So what's happening here is this chart shows you what percentage of U.S. consumer spending is being driven by the top 10% of income generators across the U.S. And what you see is about half of all U.S. consumer spending is being generated by the top 10% of earners across the U.S. That is a frightening picture, right? It is the highest level on record, where the haves feel really good and they're willing to spend, and the have-nots are spending less and less and less. And why? Well, think about it. Stock market's at all-time highs. Case-Shiller home price index is at all-time highs. So if you've got assets, you feel great. But if you don't have assets, you're struggling. 29% of Americans are living paycheck to paycheck. That's the highest number on record. 6.7% of subprime auto loans are delinquent, also the highest on record. We've got really limited wage growth. And a soft job market, which we talked about a little bit before. So the low end, really, really struggling, having a really hard time. The high end, feeling all right and feeling pretty good. And that's how you marry all these different dynamics. There's puts and takes. So if you're catering to the high end, things don't look so bad. If you're catering to the low end, it's a struggle, plain and simple. Now, if we move beyond the U.S. consumer, I just want to highlight my favorite chart in this deck is this chart here, and this is all about kind of the international demand dynamic. So, inbound foreign travel to the U.S. was up 9% year over year last year. That has since done a 180. It's down 4% year to date. Why did we do a 180? We all know there's been a lot of negative rhetoric, hostility coming out of DC towards foreign countries, whether it be tied to the tariffs or visa restrictions. Now we're talking about requiring 5 years worth of social media history to get a tourist visa in the U.S. Some of these dynamics just making the U.S. relatively unfriendly and generating animosity and hostility towards the U.S. On the flip side, international outbound travel also was up 9% year over year last year and has pulled back, but is still positive, growing 3% year to date on a year over year basis through October. Still up, which is interesting because the dollar's been falling. Usually when the dollar falls, you'll see some of that, but you'll see it turn negative. It hasn't turned negative, just the growth has slowed. And why does this matter? Well, if you go back to 2019 and you look at this right here, in 2019, the U.S. was a net importer of foreign travelers, right? So what that means is that there were about 4 million more foreign travelers coming to the U.S. than traveling from the U.S. abroad, okay? Traveling 12 months through October, here, 18 million more foreign travelers left the U.S. to go abroad than came to the U.S. That is a swing of 22 million foreign travelers. If you figure the average length of stay for an overseas trip is 4 nights, 88 million room nights. That's almost 4 percentage points of occupancy across the U.S. Say that again. This factor alone accounts for 4 percentage points of occupancy across the U.S. So until the rhetoric stops and we become more encouraging to foreigners coming to the US, this is likely to continue to see this trend emerge, and that is going to be a real challenge for the industry. It's already a challenge where occupancies are declining. Occupancies are materially lower than we've seen in past cycles, even though we don't have high supply growth. So this is something that's really important to watch. So when we think about the policies coming out of DC and the implications it has on our business, this is prime example of what's going on there. Now, not every market has the same exposure or has the same challenges. You know, not surprisingly, if you look at kind of the exposure to pre-pandemic international foreign arrivals, Miami, New York, Honolulu, San Francisco, LA, markets with a lot of exposure, and then Pittsburgh, Cincinnati, New Orleans, Raleigh, not much, not too surprising by that. If you look at where things are in terms of recovery to pre-pandemic levels, not every market's recovered the same. Dallas, Seattle, DC are back above pre-pandemic levels. Honolulu is 44% below. And that's tied to the yen being really soft relative to the US dollar. And the Japanese culture is a little bit less friendly towards hostility and aggression. And we obviously know that that's something that comes out of some of the tweets and whatnot. So that's having an impact there. Now let's move beyond this and let's talk about something really positive, right? We all want to hear some good news, right? Good news, convention bookings are great. For those of you that don't know, we track the 30 largest convention centers across the US. We get the data directly from those CVBs, your convention centers, we aggregate it and we share it right here. And what you can see is this year, definite room nights are up 4% year over year. Positive, right? Next year, they're pacing up 6% year over year. So that's looking really encouraging for next year. Convention bookings are strong. Not every market's the same. Philadelphia, San Jose, LA are up really strong. Philly is benefiting from the World Cup, the Major League Baseball All-Star Game, and the 250th anniversary celebration of the United States. Meanwhile, the weakest markets, Dallas, Austin, Houston, guess what? All three of those markets have convention centers under renovation. That's weighing on their convention bookings. So with that backdrop, this kind of frames the assumptions that drive our U.S. outlook across the economy. Forecast comes from our Moody's Analytics, who's the economist we rely on. If you look at these first three columns, GDP growth, job growth, and average unemployment, those really impact corporate transient demand. We're seeing a slowing in GDP growth, job growth is turning anemic, and unemployment rate is ticking up. It's not great for corporate transient demand as we head into 2026 and 2027. On the, corporate profits also will impact. We talked about that before. Numbers look okay for 2026, but again, we're worried that it's more about cost cutting tied to AI than it is about generating revenue growth and things like that, and boosting employment levels, et cetera. On the leisure front, consumer confidence is expected to be negative for the first half of the year and then turn positive in the back half of the year. So there's a silver lining there that things are going to start to get better. And inflation is expected to increase. Through this year before it moderates in 2027, inflation creating a headwind for some of those lower end leisure travelers. And then the dollar falling is a good thing for the U.S. hotel industry, keeping domestic travelers here and making it more affordable for foreigners to come here, which will be really important, especially as we head into the World Cup next summer, which we'll talk about a little later. So you put all that together, it kind of gives you kind of that backdrop that frames our outlook. Some of the baseline assumptions, we assume the Fed was going to cut rates this week. Woohoo, we were right. Or Moody's was right, I should say. And we expect them to continue to cut rates at 25 basis points a quarter generally. Tariffs are going to stabilize around 15% is our assumption. We don't really know where they're going to go, obviously. The Ukraine and Middle East conflicts don't escalate, and there's no near-term U.S. recession. But as we showed you, economic growth is relatively muted. Now let's talk about the outlook for the hotel industry. So when we think about those three demand segments, start with corporate transient, which is the dark blue column here. We basically expect corporate transient to pull back ever so slightly in 2026 and stabilize about 10% below pre-pandemic levels. So that when you think about the sector, that, or the segment that kind of underperformed out of the pandemic, that's corporate transient. That's kind of re-rated at a lower level than where we were pre-pandemic. On the group side of things, Group is expected to continue to improve this year. We see a little bit of strength there. We do expect some attrition from that plus 6% that we're seeing right now, but still positive. And net group, we expect to stabilize about 5% above pre-pandemic levels. So again, one of the winners coming out of the pandemic. And then leisure is fascinating. Leisure came out of the pandemic and really spiked in 2021, tied to revenge travel after the pandemic. And leisure demand has been moderating ever since across the industry. We expect it to kind of do okay in 2026, heavily influenced by the World Cup, and ultimately stabilize around 10% above pre-pandemic levels. So clearly the winner post-pandemic is leisure, followed by group, while corporate transient is the loser. When we think about other factors that are really important to our outlook for 2026 and beyond, supply growth. Good news about supply growth. Supply growth is muted. But we do expect it to tick up. This year is almost double what it was last year. Next year will tick up a little bit more than that. And then everything under construction kind of works its way through, and we see really, really muted supply growth in 27 and beyond. Net in our 5-year CAGR, we're looking at 0.7% supply growth across the US. That's almost a third of the long run average, which is just under 2%. So really, really muted supply growth going forward. That's really positive for fundamentals across the industry. Generally speaking, we don't see supply growth as an issue for any one individual market. There are locations and submarkets where it's a bigger risk. Savannah is the only market where it worries us a little bit, and that's as much about the supply that's opened as much as what's coming across Savannah. But generally speaking, supply growth is relatively muted. And while there are markets we don't like, it's really not fueled by supply growth alone for any one of those. Here is our RevPAR model. For those of you that haven't seen our data before, we actually share the backtesting of our forecast model. So the dark blue line that you see here is STR or CoStar RevPAR across the US on a seasonally adjusted basis, going back to 2000. The light blue line is the model that we've built to estimate that RevPAR. We've estimated that RevPAR historically, driven by these primary factors that you see on the left-hand side of the page. And that, based on those factors, we've built a model that basically has estimated RevPAR to within 98.8% accuracy over 25 years. So highly accurate model. That's what that R squared effectively means. And then based on Moody's Analytics forecast for those things, you see our forecast right here for where RevPAR is going to go. That little bump there is tied to the World Cup, which we'll talk about a little later. Same thing for ADR, 98.9% R squared, highly accurate model. And then when you put it together, I'm going to focus on 2026 for our forecast. Here you see our forecast versus the other guys. I think we're all pretty close on 2025 now, with 2025 kind of wrapping up. HBS is the only one that's a little bit more, we'll call it optimistic for 2025. The rest of us are all negative. And seems negative is going to be pretty right based on where we're at with the fourth quarter tracking down almost 2% right now. And that's before we get into the Christmas and New Year's difficult calendar shift. So when you look at 2026, we are going to be showing basically, we estimate that occupancy is going to decline about 1%. ADR is going to increase about 2%, and that's going to translate into RevPAR being up about 1%. What I'll highlight about this is we are the most cautious on occupancy. We have continually been the most cautious on occupancy over the past few years, and that has really played out as being accurate. We are also the most aggressive on ADR, and some of that is tied to our views of the World Cup, where we think the World Cup is going to have a really positive impact on ADR, but not so much on occupancy. And we've done some work to support that, which we'll walk through. And net, we have RevPAR up 1%. What we'll highlight is that if you back out the World Cup, which we estimate is going to have about 2 percentage point impact on RevPAR growth across the US, excluding that, US RevPAR would be down 0.5 point to a full percentage point. So we're talking about, if you're not in one of those World Cup markets, you adjust that out, we're looking at -0.5 to a point as your US benchmark. A little different, right? Now, if you look at our quarterly forecast for 2026, we expect RevPAR to stay negative in the first quarter, but then things start to turn positive in the second quarter of next year and stay positive through the remainder of the year. What's driving that positivity and that shift? Well, there's 3 core components, and they're all listed right here. The obvious, softer comps. Woohoo! We're comping against negative RevPAR growth, so that should help. Number 2 is the World Cup impact, which you're going to see right here in that 2-1 and 3-2 and 2Q and 3-2. And number three is the SALT tax reductions. Part of that big, beautiful bill that was passed last summer was a reduction in state and local income taxes. And that translates, or at least a deduction, increase in the deduction for state and local income taxes, which will put more money in people's pockets, and that will hopefully help some leisure demand in 2Q and 3Q as people file their taxes and get their refunds in April, May, June, which should be somewhat encouraging for 2Q and 3Q demand. So those are the things that are really driving that turnaround next year. Unfortunately, we didn't comp the World Cup in 2027. Moving on, if we look at price class forecast, we generally expect, look at the light blue columns here, that's 2026. The high end is going to continue to outperform. We expect luxury and upper upscale to be up 4% year over year in 2026. That's tied to two factors. One is that high-end consumer continues to perform really well. Number two is group is strong, and then group tends to be skewed to luxury and upper upscale where there's more meeting space. Whereas the good news is even the low end will be positive. So after a couple of years of negative growth at the low end, we're now forecasting positive growth. At the low end, it's just muted and not nearly as strong as what we're seeing across the US overall. And now, when we look at RevPAR growth by location type, we generally expect urban and interstate to perform best. Urban is tied to the World Cup and the World Cup as well as convention centers. And then interstate is also World Cup, where there's going to be a lot of travel on the highways during the World Cup, which we should impact interstate. We're a little more cautious in resort, which might not align super well with that luxury dynamic. And that's because we think a lot of the leisure travel that's going to happen next summer is going to be more tied to the World Cup and going to some of those urban locations than resort markets. Now, let's talk about the World Cup. So we've spent a lot of time analyzing the World Cup. We have a lot of views on this. Real simply, it's unprecedented scale. This is an amazing event or group of events across 16 cities in 3 countries. Unfortunately, there is a massive spread between stadiums. Mexico City to Vancouver is almost 5,000 kilometers. In 2022, the spread between stadiums in Qatar was 55 kilometers. So a huge, huge gap. As a result, there's high cross-city travel costs, logistical complexity for fans, and really, really importantly, most teams don't play matches in the same city on back-to-back matches, or certainly not back-to-back days. They are traveling from city to city to city. So that makes things much more complex and much more challenging. There's also extended time gaps between matches. In most cases, there's as many as 5 days between matches in a given city, which basically means if you are a traveler going to see a match in a given city, if you don't have international airlift to that city, is it really worth the effort to see one match? And then B, if it's somewhere you don't really want to be when there's not a match, do you really want to go there? Because you can go to a different city and probably see your team because teams are playing in multiple cities, and they don't necessarily have to stay in the city that they're playing a match in because they're rotating through multiple cities. So our view is a little bit different than what you might see from others. We think you really need, if you don't have a lot of international demand, international tourism, if you don't have a lot of tourism demand, you don't have a lot of international airlift, you're not going to get the same lift. We actually think the best benchmark for the World Cup in 2026 is Russia in 2018. It's not the perfect benchmark, but it's the best comparison. There were 12 host cities and almost 2,500 kilometers in separation between stadiums. Now, I will highlight that Russia does not have the same amount of hotel demand, and ADR is a lot lower, so it's a little bit of much smaller market, if you will. Therefore, the impact can be much greater. But what I think is really important is the big pushback that we get on the positive impact for the World Cup on the US is, well, but the geopolitical sentiment towards the US is so negative that we've seen these declines in international inbound arrivals. Is that really going to turn around and things are going to get better? And my answer is the sentiment to the US worse today than it was towards Russia in 2018? I certainly don't think so. I certainly hope not. And I definitely don't think so. This was shortly after Russia annexed Crimea. So I think that it's also about understanding kind of that benchmark. I'm not saying that things are rosy for the US, but when you think about Russia as a benchmark, let's see what it did. At the end of the day, it had in Russia, we saw a massive the World Cup alone increased RevPAR growth by 7 percentage points for the entire year of 2018. Importantly, in Moscow, the months of June and July, when the World Cup was being held, saw RevPAR growth 200 percentage points higher than May and August, months before and after. 200 percentage points higher. It basically impacted RevPAR across Moscow for those 2 months, impacted the entire year by over 15 percentage points. Moscow, also the biggest city, the gateway city with the international inbound arrivals, the city that international tourists want to go to. Meanwhile, how did the smaller markets that had less hotels and therefore should have impacted them more meaningfully do? They all underperformed. So as you think about that, it kind of points to this idea that, hey, the gateway cities should really outperform. We think that holds. That points to New York, LA, Miami being really, really strong. Atlanta and Dallas have great international airlift. They should do really well. And the other thing that matters is obviously the 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 schedule, and do you have great matches or do you not? Net, we think when you put all this together, we see almost 2 percentage points of tailwind from the World Cup to the US, but it is really skewed to those international gateway cities. Will there be lift in markets like Kansas City, Boston, Philadelphia? The answer is yes. Is there going to be a lot of lift? We think no. And this kind of, we walk through the schedule of what's going on here across the World Cup, and we highlight across each of these cities the 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 teams that are playing in those cities that are known to have a fan base that travels really, really well. Atlanta's got 2 matches with Spain. They're also hosting a semifinals match. So you've got 3 good matches. That's attractive. Boston, you've got England and France, which is encouraging, and that should be positive. But we'll see how that goes. The big challenge with Boston is that the matches are being played in Foxborough, which is almost an hour outside of the city. We think it's also very likely that you'll see people stay in New York and take a train up and train back. Dallas, England, and Argentina. You've actually got 2 matches with Argentina separated by 5 days. That's very attractive. And then you also host the semifinals. And then Dallas is also the media hub. So Dallas will probably perform really well. Then when you have Houston has a few decent matches, Germany, Portugal. But what you will see here is there's no kind of Latin American countries expected to play in Houston. That tends to be where a lot of Houston's international airlift comes from. So that's a little bit more muted on Houston. Kansas City does have 1 match in Argentina, but that's it. Doesn't have a ton of matches to begin with. And at the end of the day, Kansas City is not going to be too easy to get to. If I'm an Argentina fan, I'm probably more inclined to go to Dallas and see them on the 22nd and 27th than 16th in Kansas City. And then what do I do? So you might get some nice lift around that Argentina match for non-Argentina players. But moving beyond that, or non-Argentina fans, but then moving beyond that, just not going to see as much lift. Those matches aren't as good. LA's got a couple of USA matches as well as a quarterfinals match. And then moving past that, we see Miami has Colombia, Brazil, and Portugal. Really, really attractive for Miami, as well as the 3rd-place winner, which you'll see there. And then when you look at New York, New Jersey, in Meadowlands, you've got Brazil, France, Germany, England, and the championship match. New York should do really well. Philadelphia does have Brazil and France, which is encouraging. But again, I think they may face some of the challenges that Boston faces, where people can stay in New York or DC, train up or train back if they don't want to be in Philadelphia. San Francisco Bay Area, which is down in Santa Clara. Unfortunately, they don't have any of those major teams, aren't hosting any major matches. I think this is troubling. They also don't have any Asian teams that I think would be more appealing to San Francisco Bay Area and the community there. As a result, I don't think it's going to have as much of an impact on that market. Seattle gets 1 match in the USA. And then we're going to highlight Toronto and Vancouver here. The one thing that we hear from people is, well, maybe Seattle and Vancouver will get this kind of Pacific Northwest hub. we're not really believers that's going to play out. The matches aren't great in either one of them. But Seattle does have USA. But B, I'm not sure how many foreigners want to travel across the border and back. Once people are getting into the US, I think they're going to stay here as opposed to going into Canada and back. So that gives you a sense of kind of how we think about all of those different cities. Here's kind of that outlook for the foreign exchange rate, the idea that it's falling, which should be a tailwind for foreigners to come to the US for the World Cup, which should be encouraging. Again, we do not think sentiment towards the US is worse than sentiment was towards Russia in 2018. And as a result, we feel like we should see a nice lift this year. Now I'm going to show you real quickly. We have upside and downside scenarios that I'd share. From an upside scenario perspective, this is an unlikely scenario. The scenario basically says that it's in all likelihood the U.S. will not experience economic growth in the assumptions driving here. 75% probability that it won't, but it would lead to a 10% RevPAR growth next year. In a downside scenario, it's unlikely that the U.S. economy will be as bad as this scenario assumes. 75% probability that it would outperform this baseline, and it's got about a 5% RevPAR decline. Now, before I move beyond the top line, I just want to talk about a couple things real quickly. Number one is our approach to forecasting is different from other guys. We're firm believers in better data in equals better data out, also known as garbage in equals garbage out. We're the only forecasters that use Moody's Analytics for economic forecasts going forward. We think that really matters. We're the only forecaster that gets the convention pacing data directly from the CVBs or the convention centers and incorporates that into our forecast models. That really, really matters. We do a ton of work on supply ourselves. We think that matters as well. But at the end of the day, we use only the best data providers because we think that's what matters. And it leads to, in our view, better forecasts. And fortunately, it has shown out over time. So if you look at what was our forecast going into last year, so this time last year versus actual results for 2024, right? I'm sorry, not last year, but the year before. This time 2 years ago versus actual results in 2024. Well, we missed RevPAR by 60 basis points. Everybody else missed by 1 to 2%. So again, we outperformed. Numbers look relatively similar this year, although it's not final yet. And if you think this was a unique situation, it wasn't. In 21, we were the most accurate. In 22, we were the most accurate. In 23, we were not the most accurate. We think PwC deserves that credit. They were the only forecaster within 1% of occupancy and ADR growth and RevPAR growth. It was only us and them within 1% of OCC and ADR growth. You see other guys that miss in opposite directions pretty meaningfully. Up 3, down 2, up 2, down 2, up 1, down 3, etc. We tend to call those a little lucky. That's our opinion. And then if you look at it on a market level, these are the 62 markets we issue quarterly forecasts for. For 2024, we were more accurate than the other guys, 70 to 80% of our markets. That's a lot, right? And most importantly, the other guys missed by 5 percentage points more than we did in 13% of our market. That's not there's a natural disaster that nobody predicted. That's they missed the forecast really, really badly. And that happens year in and year out, where the other guys miss really badly. In fact, if you go back to 2021, you look 1 year out, we're more accurate in 80% of the major markets. 2 years out, 75% of the major markets. 3 years out, 70% of the major markets. So from that perspective, we have proven year in and year out that our forecasts are better than the other guys. And that's why our clients love the work that we do. And that's why we tend to think that people should heed what we're talking about. But we're biased, obviously. Now let's move beyond the top line. I wanted to spend a few minutes talking about profits, wages, and some of these other factors. So new union agreements have created a massive increase in wages across a lot of markets. LA saw a 40 to 50% hike last year. Boston, Chicago, or small set of hotels in Chicago, DC, all seeing massive, massive increases. In 2026, you have the New York union contract that's up for renewal at the end of June, and then you have Chicago shortly thereafter. Here's the concern, right? The concern is in New York, you have all-time high ADRs. You have a regulatory environment that is anti-Airbnb. You have a socialist mayor. And oh, by the way, you have the World Cup in town at the same time as the union contract is expiring. That is not a recipe for having a good negotiating power against the union in New York. And unfortunately, that New York contract is going to be the baseline for what happens in Chicago. So there's a huge concern for some of those. that we take really to heart. We would put a high probability that there will be a strike in New York in 2026 around the World Cup, which obviously which isn't good either. And why does all this matter? Well, it matters overall for a couple of reasons. Number one is if you're a non-union hotel but you're in a union market, you want to stay non-union. Why do you want to stay non-union? Not because you don't want to pay union wages, because you don't want to deal with the union work rules and work restrictions. So if the union pays here, you pay here to avoid the work rules. But what happens when the union goes here? You go here, right? Second thing that's going on is that the union is trying to coalesce. I'm not sure they're going to have success, but they're trying to coalesce around all their major cities coming together and having to renew in advance of the Olympics in 2028. Not sure they're going to have success doing that, but that's what they're trying to do. So they're looking at a couple year extension instead of a 5 or 10 year agreement with some of these cities. If that happens, it's going to have a monumental impact across the board. So we're really mindful of that. We're really worried about some of these major urban markets where unions have a lot of strength because the work rule restrictions are really onerous and it's really challenging. And on top of that, when we think about some of those major urban markets, we also see political risks. Obviously, I'm sure most people on this call are familiar with what we saw in LA with minimum wage increasing roughly 40% over a few years. Guess what? That spilled over to San Diego, 45% increase over the current rate by 2030. We've got other rules going through California. If we think you're stopping California, you're wrong. The Safe Hotels Act in New York, which was pretty meaningful, except a lot of the hotels managed to figure out a loophole and grandfather themselves in to long-term contracts with third-party labor providers. And then, for those of you that aren't paying attention with what's going on in Chicago, the mayor put forth a plan in the budget to charge $21 per employee per month as a tax when companies bring employees into their offices in the city. They're calling it the head tax. Staggering number. You think that's going to help boost office utilization? Oh no, companies are going to say either they're going to move away or they're not going to or they're not going to encourage their employees to come to the office because it's expensive. It's going to cost them a lot of money. Staggering dynamic going on there. That's not encouraging for the hotel industry in general. So these political risks across what I like to refer to as the big blue cities are a real concern. Put it all together, as I talked about before, wage growth this year has been really muted. It's encouraging. It'll pick up over the next few years, but we're looking at just a 2.6% CAGR over the next 5 years. Property taxes will continue to increase, as will insurance and other expenses. Overall expenses are low over these next couple of years just because occupancy is declining before we start to see expenses pick up. Overall, we've got, as I mentioned earlier, declining EBITDA this year, relatively flat next year, and then you see a modest pullback in 2027 on that comp against the World Cup, and then we start to see growth in EBITDA finally 28, 29, and 2030. Here's our cap rate model, similar to what we showed you with ADR and RevPAR, and when you put that together, you can see basically put it all together here, you get an outlook that basically points to RevPAR growth that's going to be relatively muted over the next few years. We've got a 1.6% compound annual growth rate through 2029. EBITDA is soft, only up about 0.5% for that same period. Cap rates we expect to drift nominally higher over the next few years, and values will decline this year, as we talked about earlier, flatline next year, and then we'll start to see modest growth in the years that follow. Now, let's talk about markets. These are the 62 markets I issue quarterly forecasts for. We issue these every quarter for all of these markets. This is the 2025 chart that I showed you before from a RevPAR growth perspective. I'm not going to spend much time here because we really care about 2026. So this is our 2026 outlook. When you look at 2026, you see big divergence again, just like we've seen over the past couple of years. Some of the strongest growth is in markets that either have soft comps, Maui with the wildfires, special events calendar. I talked about Philadelphia with not only the World Cup, but the MLB All-Star Game and the 250th anniversary. LA is a World Cup. Miami World Cup, New York World Cup. You get the idea. And those that have really outsized economic growth, like Palm Beach. And then you have markets down on this side where you've got sluggish economic growth like Pittsburgh and Cleveland. You've got difficult comps. Pittsburgh certainly has difficult comps this year, as well as Kauai, St. Louis, and Tampa all having some challenging comps. And then Austin has the convention center closed for renovation. So that's impacting those markets. And then if you take a longer term view, and this is 2024 to 2029, 2024 being the baseline because 2025 isn't complete yet. Our top performers, Maui, soft comps, as we talked about. You also see, markets that are going through major shifts tied to added demand across the market. Palm Beach is transitioning into a major corporate player, where it wasn't before. Raleigh's got massive growth on the corporate side, on the leisure side, and the new convention center, all phenomenal. And then you have other markets that are seeing strong economic trends. San Antonio and Sedona stand out. Special event calendar, LA, Fort Worth, which obviously Fort Worth is where the Arlington Stadium is, and then those robust convention calendars, Orlando, San Antonio stand out. And then when you look at the bottom performers, you're looking at Cincinnati, Louisville, Pittsburgh, all have sluggish economic growth. We talked about Austin having a soft convention calendar with the convention center under the knife. Houston has a soft convention calendar and difficult comps, and DC has really soft government demand. And if we move beyond the top line, let's talk about value. Our favorite markets for investment right now, Orlando, New Orleans, and Tampa really stand out. Orlando, you've got new attractions like Epic Universe, a strong convention calendar, modest expense growth, all going to drive values higher. New Orleans, great convention calendar. New Orleans is one of the big winners with all those Texas convention centers under renovation. We see strong convention calendars. We also see a dynamic where the convention center is going through a transformation where they're going to create an events district around the convention center. And we think that's super, super positive over the long term for that market along the river. Really, really positive. That will create a lot of value for that market because that is a convention market more than anything else. And then Tampa, strong economic growth, robust convention calendar, especially in the out years, and an attractive value proposition relative to South Florida for those beach travelers and the leisure dynamics. And we think that's going to outperform in the next few years. We also like Charlotte a lot, Puerto Rico a lot, Miami. What you'll notice about all those markets is they are all low-cost markets. Those are markets where your red states, relatively favorable cost dynamics. Bottom performers, soft convention calendars, Austin and Dallas, as we talked about with convention centers under renovation, elevated expense growth, Chicago, New York, DC, and then DC also has declining government demand. Now, before we stop and take questions, I just want to spend a couple minutes for those of you that aren't familiar with our offerings and our products. LARC issues quarterly, we refer to as market intelligence reports, basically reports with everything we know about a hotel market, all the backdrop, including supply, demand, occupancy, ADR, RevPAR, wages, property taxes, hotel EBITDA, cap rates, margins, and hotel value forecasts for the next 5 years. We also have this super cool application called LARC GIS. Have not seen it and you want to check it out, just let us know. It's an amazing application. You can basically select a development site or a hotel, draw an area around the hotel, and extract all kinds of data from that area, including an annual RevPAR forecast for each of the next 5 years. And there's a lot more in there than that. It's kind of one of the cool things. And then we also offer advisory services to our clients, whether you're looking for bespoke reports tied to budgeting or underwriting individual assets, or you're looking for investment strategy support, market strategy support, you name it. We do all that work. And then if you have any questions, want to reach out, this is the best way to get a hold of us. It's probably the easiest way. We also, if you want to purchase any of our reports, you can do it right online at our website, larkanalytics.com/shop. You can go ahead and select a report, pay with your credit card right there. You can download the report on the fly right there. You don't need to interact with anybody. Super easy, no issues. With that, Katie, are you there? Are you ready? Are we ready to take Q&A?
Yes, we are ready.
All right,
So,
let's do it.
first question, do you think there could be an adverse effect to the lodging industry from the reduction of white-collar jobs due to AI disruption?
There is risk. There's no doubt about it. That risk doesn't happen overnight. It's more gradual. And the bigger question that we're seeing right now, and I'm not saying what's what we're seeing right now, but it can change, is right now, a lot of those white collar jobs that AI is positioned to replace are more entry level employees, the ones that don't do as much corporate transient travel. Doesn't mean to say that it won't move up, and it can, but it doesn't seem to be an immediate threat, but it is a concern.
If you had to predict rate of inflation over the next 5 years, what would you guesstimate? And what about food/groceries?
Um, I think we pull the data from Moody's, and I'm not the economist that's going to forecast inflation, so I would point to them. And they're basically forecasting next year is going to be north of 3%. It's going to drift down closer to 2%, and it'll probably hover between 2 and 3% over the next few years.
For the consumer spending power of the top 10%, from roughly 1999 to 2013, the number bounced between 40 and 45%. Why the level of concern that this amount has now been between 45 to 50%? I understand the concern about concentration, but we have been concentrated for 25 plus years. Yes, the trend is increasing. Said another way, is 45 to 50% meaningfully more concentrated than 40 to 45%?
I think if you think about the top 10% driving 5% more spending than we've seen historically, that's a massive shift. That's a massive, massive shift. If you just look at the numbers and the way that is, because you're talking 10% is impacting things by across the US by 5%. That's growing. They're growing by 50% effectively relative to everybody else. So they're driving that growth more than anything else, and that's the bottom line. Is the 49.2 so much worse than 45? I wouldn't say it's so much worse, but we're in an environment where we don't have a lot of consumer spending growth, and what we can identify is all of the consumer spending growth is coming from that top 10%, while everybody else is actually seeing declines.
If the top 10% is what is traveling, why are the resorts not predicted to produce greater growth?
Talked about it before. It's because we think that, and this is resort markets, so it's not necessarily high-end resorts. Think about Virginia Beach. I don't call that a top 10% type market. Or Myrtle Beach or Hilton Head, those types of markets aren't necessarily tied to the top 10%. That's first and foremost. The second thing that I would highlight is when you think about the summer leisure travel season, we just think there's going to be a lot more skew to the urban markets because of the World Cup, and that's going to come at the expense of the resorts.
What's driving the RevPAR growth prediction in the lower chain scale segments next year? Is it solely weaker 2025 comps? I don't expect the World Cup to have much impact on lower chain scale segments.
Yeah, I don't think it's as much about the World Cup. I'd agree with that statement. It's driven by a couple things. Yes, comps are easier. Comps are easier isn't a good enough reason. It's also that SALT tax benefit where state and local tax benefits are going to translate into a little bit more money in the lower end consumer's wallet. Consumer confidence is forecasted to tick back up in the back half of next year. All of those types of things combine to give us a little bit more positivity. Don't get me wrong, we're not bullish. We're not sitting there saying, hey, economy and mid-scale are going to be the best performers. You're just going to experience modest growth as opposed to seeing declines.
For World Cup, were countries with travel bans, for instance, Iran playing in LA, considered for the sentiment, or do you anticipate the bans will be lifted for purposes of those traveling in for the games?
I don't think the bans are going to be lifted for the games. I don't think this administration is willing to make those types of choices. So there's no doubt it's probably not going to help. That being said, Iran isn't a country that has generated a lot of foreign travel to the U.S. period, and it's also not known as a big fan base that travels a lot for the World Cup. Unlike the Argentinas, the Brazils, the Portugal, England, France, Spain, etc. So less of a concern.
Do you think the World Cup will impact the hotel market in Long Island, or is it too far away since they'll play at MetLife?
It's probably too far away, but it may have a marginal impact because I think the ADR levels in New York and New Jersey around the Meadowlands are going to be super, super high. And there may be people that are saying, hey, this is really expensive. If I can get a hotel out in Long Island and take LIRR to Penn Station and transfer from LIRR to New Jersey Transit and get to the Meadowlands pretty easily, maybe I'm willing to do it. You could see that happen.
Do we have insight on airline/hotel booking pace by foreigners who plan on attending the World Cup? If so, is it higher or lower than expected?
I think it's too early right now. It is very early days. The World Cup cities and teams and matches were literally announced Friday and Saturday of last week. So give it a few months, and then hopefully there will be some data out there.
Are Trump's policies creating a more favorable environment for unions?
I definitely wouldn't say Trump's policies create a more favorable environment for unions. I would say the opposite. Unfortunately, the unions also operate within big blue cities, and I think a lot of the mayors of those cities are creating more favorable environments for unions.
Based on your slide illustrating the discrepancy between lower priced and higher priced travelers, which markets will be most negatively impacted? An example, Orlando?
I think that obviously when you think about the leisure consumer, if you think about that top 10%, they're going to stay at luxury properties. And it's not just about the market, it's about the property within the market. They're going to choose to travel abroad. They're going to spend more money, high-end resorts. Orlando has plenty of that. There's a lot, people spend a lot of money in Orlando every year. It's not just kind of a middle class market, but it does have a lot of middle class exposure too. I think that top 10% dynamic, and that's just one component that's really tied to leisure transient domestic travel, right? Which is not every market, doesn't impact every hotel the same. We're going to see we have convention calendars that are strong that will impact markets like Orlando. We have foreign inbound arrivals that we expect to recover. We have the World Cup that we talked about. There's all kinds of different factors that are going to impact all these markets. But we think that when you think about leisure transient travel in general, the high end is going to outperform, just like it has been. We expect it to continue.
The prices of World Cup ticket prices have been receiving a lot of negative press. Do you think this could risk international attendance or performance of World Cup in general?
I think it always risks it, but I doubt it's going to be too much of a concern. I think the fan bases of the the teams that travel really well, they're willing to spend a lot of money to watch their team in the World Cup.
Is your valuation methodology underpinning the 5% growth over the next 5 years?
I'm not sure what 5% growth that's referring to. Maybe the person can chime in on that. We don't have 5% growth over the next 5 years, I think, over anything other than maybe property taxes. And if that's the question, then property taxes aren't driven by property values, they're driven by municipal budgets. If cities have to, cities are spending, 10% more to cover, to manage the city, they have to raise 10% more revenue. And that often comes in the form of taxes. It's not all property taxes, it's sales taxes, it's income taxes, it's all kinds of other factors. But generally speaking, you will see we have great transparency, as Katie knows, because she does a lot of the research. We have great transparency in where municipal budgets are going over the next few years and what they're projecting their property tax increases to be. So there are obviously hotels that can appeal those property tax increases and the assessments, but generally speaking, you are seeing property taxes moving higher because municipalities have to fund their costs.
Why invest in hotel real estate given your prognosis?
Now that's a great question, and I think the answer is real quickly. Simple. Number one is, as we talked about before, not every market is the same. So some markets are way better than others. Some markets way worse than others. So just like any investment, you don't necessarily want to take miss the trees for the forest, if you will, right? There are going to be winners and there are going to be losers. Identifying the winners and losers is paramount. If you're trying to take a broad-based, I just want to invest in hotel real estate. We think there's going to be a lot of challenges, but that doesn't mean that there aren't going to be great investments in hotel real estate. We think there's going to be a lot of great investments in hotel real estate. But if you're trying to take a catch-all approach, doesn't matter what I buy, good luck. And I think that's going to be the case for any investment you make. Good luck if it doesn't matter what you buy within that sector.
Tariff affecting regions or cities differently.
I think that we don't have a ton of clarity on how tariffs are moving. They move differently every month. Trump comes out and announces a 100% tariff on some good from China, and then a week later backs off of it. We also don't know if the tariffs are going to be deemed legal as soon as the Supreme Court comes back. So it's hard to clarify anything with any confidence. So we don't really comment on things like that.
This one's more of a compliment, but Ryan is the best. I love his Nordic background. Great call and thank him for his thoughtful response to my question.
You're welcome.
How likely will the 2000 tariff dividend check actually come? And does your forecast take that into consideration?
We think it's likely because the SALT, I assume you're referring to the SALT rebate. That's likely. That's law. That was signed into law by Congress with the big beautiful bill. So you have a deduction in federal income taxes tied to the state and local income taxes at a greater level than you've had before. That's happened. Done. You'd have to have a law to change it the other way. It's already in place, and I don't think anybody's going to pull it back. If you're talking about the dividend on the tariffs, I think good luck. We think it's more likely that the tariffs are deemed illegal by the Supreme Court, and then you have to pay the $100 billion back. be. Trump talked about the big beautiful bill and the tax reduction being funded by the tariffs. How can he fund those expenses by the tariffs if he's giving out a $2,000 dividend check from the tariffs to other people? If that's what you're referring to, I don't think that's going to happen at all. I think that's just sowing confusion.
New Jersey games. Do you think people will be more likely to stay in New Jersey, very close to the stadium, or in Manhattan due to it being more tourist oriented? I think you kind of touched on this.
Yeah, I mean, I think they'll stay in Manhattan, but that doesn't mean people aren't going to stay in New Jersey. I think they absolutely will. I think there's going to be a lot of travelers to the market. At the end of the day, um, when you think about where people want to be, where do international travelers want to spend their time? If you're coming into town for a game and you're staying for 4 or 5 days, you don't necessarily want to stay at the game. You want to stay in the city, in town, Times Square area. You'll go out for the game. There will be people that'll say, "Hey, we can stay in Jersey City. It's easy to get to the game, easy to get into Manhattan. We'll do all those things." There will be a little bit of both. Don't get me wrong, but Manhattan will probably benefit more.
Minimal RevPAR growth and expenses offsetting that growth and more. What is the basis of your property tax growth assumption of 5%? I think that's the
I think we
clarification.
just talked we
Yeah.
just talked through it. It's not about property values. It's about municipal budgets.
And as of right now, this next question will be the last one. How much should a CMBS fixed income investor in the lodging sector care about the effects of the 2026 World Cup as more than a positive blip in the lodging cycle?
Probably shouldn't. As a CMBS investor, you're looking at long-term risk tied to, um, a swath of assets backed by your bonds, or your bonds are backing, right? So I don't think it does have much of an impact for a CMBS investor. But for the hotel operators who are trying to figure out how to operate their business on this call, I think it's incredibly relevant for investors that are buying individual hotels that are underwriting cash flows. Near-term cash flow being stronger is also relevant. But for a CMBS investor, I can't imagine how it is.
And that's it.
Great. Well, thank you all for joining. I appreciate you taking the time. I'm going to go ahead and stop that share right now. Hope you enjoyed my lovely background at our cabin up in Vermont, where we got here last night. It was snowing and had a blast. But if you have questions, if you need anything from us, don't hesitate to reach out. Again, my name is Ryan Malacher, president and co-founder of LARC, Lodging Analytics Research and Consulting. The easiest way to get a hold of us is information at larkanalytics.com. Thanks so much and have a great day.